What is a bank? A bank, by definition, is an institution whose primary function is to store deposited money while also providing lending services to customers. Banks play a critical role in the economy because they help to store and create money. Banks store money in a couple of ways. The first is to keep a percentage of deposited money on hand just in case it is asked for by a customer. The other way is to invest it into bonds or other investments as a means to grow the money that is deposited. Other functions a bank may offer include check cashing, issuance of certified checks, wire transfers from one party to another, and investment services. Types of banks. Banks are established to serve different purposes in an economy's aspects of money growth and circulation. Some banks focus exclusively on one sector of banking, while others may be diverse in their offerings. Here are the different types of banks and what they are for. Retail banks. This is the most familiar form of bank for most as it is the kind that handles the funds of individuals and the public. Retail banks offer a wide variety of products and services to customers, from checking and savings to small and larger loans and even certain investment products. Commercial banks. Commercial banks work exclusively for businesses. They are similar to retail banks in their offerings but are suited for corporations or other large institutions such as governments and colleges. Investment banks. Investment banks exist solely to help individuals and businesses navigate the world of investing. They provide advice and facilitate mergers and acquisitions. They also help businesses to fundraise for capital when it is needed. They do not offer regular checking and savings services like commercial and retail banks. Central banks. Central banks exist to set monetary policies and dictate certain economic factors to help regulate the economy, keeping it growing and stable. They also control the amount of money produced to maintain its value. In the United States, the central bank is known as the Federal Reserve. How banking systems work. The banking system in most countries operates on a concept known as fractional banking. When a customer deposits money into their account, the bank takes all but a certain percentage of that money and puts it toward loans and other investments for other customers. When a bank has several customers doing this per day, they can maintain a growing banking system within their walls. In order to provide cash to customers when needed, a bank must maintain a reserve percentage on hand at all times. This may be anywhere from 3 to 10%, depending on how much the bank is holding at the time in terms of assets. Reserves are kept because it is assumed that normal banking activities will allow the bank to generate or receive money regularly in proportion to the demand for withdrawals that would come to them at a given moment. There have been historical examples, however, of when there has been economic concern in the public, which prompts people to demand larger withdrawals from their account, known as a run on the bank. This level of demand can sometimes strain a bank and leave some unable to access their money because the bank cannot meet the demand for withdrawals at that time. How do banks make money? Most banks are for-profit businesses, so they must make money from providing their services. Working hand in hand with how fractional banking operates, the loans a bank issues to customers come with interest. Interest is a percentage of money that the borrower owes to a lender in addition to the principal amount lent. As a simplified example, if a person is issued a loan for $10,000 with a 3% interest rate, the borrower pays a total of $10,300. That is an extra $300 coming back to the bank. However, most interest is calculated on an annual basis, so the real calculation is slightly more involved. Fees are another way in which a bank can generate extra money. Fees for maintaining a checking account, having storage in a safety deposit box, and automatic bill paying are ways a bank can make money providing customer services. Fees for more negative issues such as insufficient funds in an account and overdraft coverage may also help to generate extra. Banks also will invest some of the money that is deposited into certain bonds and other products, which increases their long-term earning. Bank money is used by institutions to facilitate the transfer of funds that are backed by another asset. The use of bank money comes with a transfer fee, which is another means by which a bank makes money.